Hello and welcome. My name is Jo Phillips and I am Director of Research and Innovation at Nest Insight. Just a few bits of housekeeping with apologies that we always have to start with these things. So there are no planned fire alarms. If the alarm does go off, it's exit via the main stairs and assemble in Carteret Street. Not sure if I said that right. There are toilets by the lifts. The men's toilets are upper floor or down a floor. We've got teas and coffees next door if you haven't found that room yet. We've got a break and some time afterwards as well. We've got a few latecomers because there have been some transport issues this morning, so apologies if there's a bit of disruption as people come in. And please ask any of the Nest Insight team if you need anything or if we can do anything to make you more comfortable. For those of you who are new to Nest Insight, we are a public benefit research and innovation centre with a mission of finding what really works to support low and moderate income households to build financial security. And we think about that both today and also into the longer term, into retirement, and to use that understanding to drive transformational change in the system, that the ecosystem that surrounds low and moderate income households and their money management, and all of you today represent parts of that system. We've got a packed agenda, we've got some really excellent speakers, some new research results, and a chance for you all to help us share, to shape the next steps in this research, because this is not the end of the research, it's really just the beginning. We've got a short 10-minute comfort break, partway through before the second panel, and I'm really looking forward to hearing from from all of you at the tables or in the breaks that we have. I'll also just say a quick hello to any future viewers. We're recording this. This is a long-term challenge, so even if you're not in the room today, we would love to hear from you and kind of please do be in touch. So to set us up, I want to do just a couple of quick bits of framing. This is one of those pieces of data that is shared in different ways. Many of you will have heard this before. Nearly 2 in 5 people in the UK would not be able to meet an unexpected expense of £250 from cash or savings. I think the thing that some research we've done recently has sort of put into sharp focus is that if we zoom in, not on all of the UK population, but on low and moderate income households, we see that it's actually much more acute than that. So it's around half of low and moderate income households could not afford that £250 expense. I'm just going to pause there because that's why we're here today. It's to address that challenge. At Nest Insight, we've been looking at different ways to do that. And I am sort of really excited about the potential of the thing that we're here to talk about today. Why does it matter? I think we should also be clear about this, because low financial resilience is not just about kind of how many pounds you have in the bank. It is really costing households, constraining businesses, and holding back economic growth. And on this slide, we just have a few of the ways that we see that in the research that we've done. So the first is that people who lack financial resilience are more likely to be in persistent debt. 1 in 4 households with low financial resilience are behind on 2 or more consecutive bills or payments. And nearly half have credit card debt that's not paid off each month, with an average debt of over £3,000. That is money that households don't have available to them to afford their living costs, to participate fully in society and in the economy. It's a drain. It means that, you know, the amount that people are paid by their employer doesn't go as far, doesn't feel as much. We also know that financial precarity takes its toll on health and people's relationships, and there are clearly both individual and societal costs of that. So, for example, we've seen in recent research that those who are struggling financially visit their GP quite a lot more often than those who aren't. And we also know that people who lack financial resilience and are worried about money are less able to be in work and are less likely to work productively when they are. So this all means that those who lack financial resilience often also lack the time, the energy, the headspace to take steps to try and build that resilience. And that's why we look for ways to make it as easy as possible for people to make progress towards greater resilience, including getting started with saving. And we've seen really meaningful impact in our work to make it easier for people to save through the workplace, which many of you will be familiar with. We now have proven payroll savings approaches that we know are effective and inclusive, and we're working collaboratively with employers and providers to implement those approaches at scale, including through the new National Coalition for Workplace Savings, which is launching in a couple of weeks. It's a really good example of testing, learning, finding out what works, and then helping it to scale we're at an earlier stage with this work, but we think it has similar potential for scale and future. So today we are looking at work that builds on the evidence and understanding we have from our workplace savings work and considers another potentially powerful touchpoint, loans. So 84% of UK adults in the past 12 months held a loan or a credit card. And given what we've just said about households that lack financial resilience, that is potentially a way of reaching people and thinking about how more people could be supported to save. So in this work, we're considering whether solutions that link borrowing and saving can boost financial resilience better than loan-only options and improve people's ability to weather financial shocks. So to kick us off, I am delighted to welcome Vicky Brownridge from StepChange, who has kindly agreed to share her perspective on what it's like to be a borrower right now and the ways in which lending does or doesn't support financial resilience. Thanks, Vicky.
Good morning, everyone. Thank you, Jo. Thank you for inviting me to speak this morning. It's a privilege to be here. For those of you who don't know me, I'm Vicky Brownridge and I'm Chief Executive of StepChange. We're a national charity and FCA authorised. We specialise in debt advice and debt solutions, which we offer across the whole of the UK through our free online and telephone-based services. We've been around for more than a quarter of a century, and we take around 170,000 people every year through full debt advice. And we also support around 200,000 people a year with debt management plans. We're now 1 year into our 5-year strategy, which includes a bold vision to move beyond crisis support and enable clients to build long-term financial resilience. That's an exact chime with the Nest Insight project, the aims of which we fully support. Our take, though, is very specific, as we look at the market from a perspective of people whose debts have become unmanageable, rather than the perspective of many people for whom credit is working well as a facilitator for their aspirations. So you may wonder whether the issue of savings is relevant from our perspective. Surely people who are in debt don't have any ability to save, you may think. I want to show you why we are not only taking active interest in the savings sector, but also why it's directly relevant and potentially of high positive impact to people experiencing problem debt, and especially of those who successfully deal with debt and seek a more financially resilient future. So first, let me give you a basic sketch of StepChange clients, although of course all of our clients and their circumstances vary widely. 3 in 5 of our clients in 2025 were in employment, with 44% of them working full-time. 2 in 5 were in receipt of universal credit. Over 3 in 5 of our clients were renters, and women were more likely to seek help than men. All age groups were represented, but the largest cohort of clients was in the 25 to 34 age bracket. And the average combined total of outstanding credit and household bill arrears was nearly £20,000 per client. Now, over time, we've seen a significant change in our client profile and in the drivers of debt. Whereas consumer credit used to be the overwhelming bulk of what we help clients to deal with, this has now also spread much more widely across essential household bills such as rent, council tax and utility bill arrears. With many clients on low to middle incomes, essential bills take up an increasingly high proportion of people's income, and more than a quarter of our clients have no surplus available for debt repayment after taking account of their essential expenditure and priority debts. The clever title of today and of Nest Insight's report, More Than a Loan, has an echo of a different theme which we see all the time as a debt advice charity, which is loneliness that can come with debt. Not just the sense of feeling alone with your financial difficulty, but often the very literal loneliness that comes with the social isolation that can emerge as a result of not being able to afford transport costs and social activities, for example. Repaying problem debt can be an ongoing process for many years, sometimes as long as a decade, even when being supported by an organisation like StepChange. During this time, many are living a frugal life, with expenditure focused largely on essentials. Yes, even at the end of this process, few people have gained the kind of financial resilience that will increase their financial security and safeguard them against life shocks in the longer term. So we've been grappling ourselves with 2 questions. First, how can we help clients gradually build a rainy day fund even during debt repayment period to help them weather life's challenges? And second, how can we help people build financial resilience for the long term after they have successfully become debt-free? These are two outcomes that we really want our clients to be able to achieve, and it's what they want to. For example, in 2019, 77% of our clients said 15 months after debt advice that they thought it important to have savings for a rainy day. But since then, there has been an increasingly significant mismatch between people's aspiration and their ability to achieve it. In our world, the product to date that has shown the most promise in terms of supporting these aims has been the government-backed Help to Save scheme. This provides a significant incentive boost to savings for those who are eligible to and can afford to access it. It enables people claiming universal credit or tax credits in work to receive a generous bonus on savings that they make of between £1 and £50 a month. After 4 years, people will have received a bonus of 50% on the money they have saved, far more than would be available in any other kind of savings account. The scheme had been due to end in April 2025, but has now been made permanent, and eligibility has been expanded to more of those receiving universal credit, including parents and carers from 2028. So far, so good. However, Help to Save scheme is aimed squarely at those on universal credit, is so far only extended to 2027, and only around 1 in 6 of those eligible are actually using the scheme. So although it shows great promise, it is only part of the solution to financial resilience. Specifically, as we all know, there are many people whose finances are finely balanced and who are far from well off, who nevertheless cannot qualify for this generously incentivised scheme. So schemes that make it easier and more attractive to save while you're also borrowing clearly have a role to play in the market, as Help to Save alone isn't a silver bullet. Recognising this, we're in the late stages of planning a partnership with a financial institution to offer the potential for our clients who are heading towards becoming debt-free to access a follow-on savings product that would echo the aims of the transitional savings referenced in the Nest Insights report. This is something that we see as a valuable way of trying to help our clients who successfully get out of debt to build the future resilience that means they are less likely to suffer repeated episodes of financial difficulty. We also know from multiple pieces of research that we've done among our clients is that financial shocks are common. Almost half of UK adults will have experienced a major life event in the last 2 years, and around 7 in 10 people experiencing problem debt have experienced a life shock. Our research shows that 4 in 10 UK adults say they wouldn't be able to meet an unexpected £1,000 expense without borrowing. Building on StepChange work, research commissioned by the Building Society Association recently estimated that holding at least £2,000 in savings is associated with a nearly 60% reduction in the odds of falling behind with household bills or becoming over-indebted. Now, we have previously estimated that having £1,000 in accessible cash savings reduces the likelihood of a household falling into debt by 44%, and that if every household in Great Britain had at least £1,000 saved, it would reduce the number of people in problem debt by 500,000. Even for those who cannot manage that amount, a regular savings habit is associated with lower risk of falling behind with bills. What is tragic against that backdrop is that the reality is that further borrowing is a more common coping strategy for dealing with an unforeseeable financial shock than having access to a rainy day fund. 9 million people have recently used credit to cover essential costs, with credit card borrowing accounting for the bulk of this. We can see how counterproductive this can be. According to our research, 7 in 10 of those using credit as a safety net report negative impact on their health, relationships, or ability to work. This is 5 times the proportion of others who hold credit products that are not being used as an emergency form of funding. 2/3 of those using credit as a safety net have kept up with the credit repayments by missing household bills or utility bills, using more credit or cutting back on to the point of hardship. This compares to 1 in 10 among others who hold credit products. And let's just pause on the following. People who use credit cards or an overdraft to cope financially after a life event were 10 times more likely to be in problem debt than those who got by without using them. So it seems pretty clear that having a savings pot would be a preferable alternative to households, even those, or perhaps especially those, in the process of repaying debt, than turning to further borrowing. Now, we aren't going to achieve this universal levels of savings overnight, but every little helps. And just to knock on the head the idea that people who are repaying debt should always concentrate on paying it down before they think about saving, we would say that we see every day the realities of life and how unforeseen events continue to happen to people, even when they're in the middle of a debt repayment plan. The broken washing machine, the essential car repair, the child's homework computer that's no longer working. None of these respect the finely balanced budget that can't afford to go out of kilter. So, although there is certainly a potential risk that debt takes longer to repay if some income is squirreled away into savings, on a modest level, this could make the difference between coping and not coping with ordinary financial hiccups of life. It could also reduce the risk of derailing a debt repayment plan or creating a knock-on displacement effect where arrears build up again. I hope these thoughts are helpful in explaining why we see savings as so crucial to financial resilience, as well as financial inclusion, from the very particular viewpoint of debt advice. Obviously, there is also wider application to households who are financially balanced but not yet financially resilient. As we all think further about how to achieve good long-term outcomes for clients in line with the FCA expectations and good practice, I hope we will see increasing collaboration towards increasing the culture and structural support that will help support rainy day savings for a greater number of households. And a big thank you to Nest Insight for bringing us together today to consider these important issues. Thank you.
Thank you so much, Vicky. That's such a helpful setup, both in terms of thinking about the preventative power of some of the things we're going to be talking about, but also the kind of rebuilding power if we're not there early enough for the preventative work. I'd like to ask the first panel to join me on stage, please. So I am delighted to welcome today, first of all, Erin Norton-Brown, who is Research Lead at Nest Insight for our financial resilience work. We also have Caroline Richardson, who is CEO of Cardiff and Vale Credit Union, who are one of the credit unions that we've been working with. Emily Trant, who is Chief Impact Officer at Stream, and Asesh Sarkar, who is CEO at Salary Finance. Both Stream and Salary Finance are our trial delivery partners, and we're really grateful to both of you for your collaboration and your innovation. So to start us off, Erin is going to share some of the learnings from the initial research with us.
Brilliant. Can I check this microphone's working? Brilliant. Thank you so much, Vicky. I feel like that was a really good setup for some of the research findings we're going to go through. Before I do, I just want to echo a big thanks to the many, many research partners that were involved in this research, whether that be the Personal Finance Research Centre at University of Bristol, the Financial Inclusion Centre, all of our credit union partners, of course, and Stream, Salary Finance and Harvard, and actually many, many more. But I also want to thank everyone here in the room today, the experts and industry leaders. You giving your commitment and your expertise in this room today means a lot, and that's both from a professional standpoint, but also a personal one, as someone who has historical lived experience of the issues we're talking about today. So I want to thank you first for being here. So, when we talk about financial resilience, we tend to think about borrowing and saving as very separate things. You might borrow when you need to, and you save when you can. But I'm sure everyone here in this room, and Vicky's already touched on it, knows that piece of advice that gets bandied around a lot, that we should always pay off our debts before we start saving. But actually, our research finds that 1 in 3 low to moderate income households are already saving alongside borrowing. So this isn't just an edge case. It's a really common way we're seeing people manage their finances. And at Nest Insight, we've seen time and time again in things like our real accounts work that people on low to moderate incomes are often really strong money managers for their own personal circumstances. And so it's things like that that led us to consider what are the reasons that people might actually find this beneficial to them, and to start to test and evaluate some solutions that are designed to support this behaviour rather than let it sit in product silos. And so then we come to today and the shiny, beautiful report in front of you. Thank you, comms team. So our research, More Than a Loan, asks, could loans do more than just meet that immediate urgent need? What if they could help build longer-term financial resilience? And so we look at this in 3 different ways in the research. So we look at those who you might say are naturally borrowing and saving through things like a national survey and secondary data analysis. We also look at the credit union sector, who for decades now have been working with members on these exact challenges and actually evaluating models that they already have. And we also have 3 brand new real-world trials happening as well. And so the models that we've been evaluating and testing really make use of different moments within the loan journey. So within the credit union sector, for example, we have Save As You Repay loans. So these tend to be savings integrated right from the very start of a loan application, and they're very popular in the sector. They integrate and automate the savings element right from the very start. So often this looks like an automated payment of, let's say, £4 to £10 each month alongside a debt repayment. But we've also started testing behavioural nudges to actually opt into saving from early on in that loan repayment journey in a trial with Salary Finance. And thirdly, we've got 2 trials actually happening that look more about the end of loan repayment moment. So here we're trying to encourage borrowers to transition into saving, similar to how Vicky mentioned. So this is about redirecting your loan repayment into a savings deposit and playing on that concept of the found money at the end of loan repayment. Now, the 3 trials that I've just set out are still relatively early days in terms of their findings, but our More Than a Loan report that you see in front of you today builds on the wealth of evidence we have from the other work streams and what we've seen so far from the trials. Now I'm going to have some water. So there's 4 key headings, key insights that we found so far. The first one is that loans can and do act as a gateway to saving. When saving is built into the loan journey right from the start, just like in the credit union model, we see really large numbers of people who weren't saving before get over that first barrier to actually starting, which we all know is the most difficult. And when they do, they save more, both in terms of the amount they save into the pot and also how regularly they save into that pot as well. And some actually start taking steps to start identifying as savers as well, such as setting new savings goals. And then when they come to the end of the loan, we are seeing an effect where people do continue to save more once the requirement is no longer there at the end of the loan. This isn't the case for all, but that habit is sticking for some groups. So I think what this shows is there's a real key opportunity to build saving into this early moment where there's a high sort of motivation to get the loan without having to make more decisions or more admin further down the line. But then in contrast, we've also been testing that idea of transition to save. Now, looking at the end of the loan point, it doesn't seem from our research so far that this is as successful at generating new savers for the first time. Now, I should say this is coming from our trial with Stream, who already have a really, really brilliant high rate of savings. So it could just be that we're seeing a bit of a ceiling effect there. However, it seems like this end of loan moment is a much stronger opportunity for those that already have a savings account open and in place. And in fact, Stream have told us they see 78% of those that have a savings account in one click will agree to upping their savings deposits when they get to that moment, which is a really strong opportunity. Now, in our trial analysis, this seems to bear out. There is an effect that we think we're seeing where sustainability seems to remain a challenge, which is something I think we'll discuss as a panel later. So that's the effect on savings behaviours, but I think we all know that financial resilience isn't just about putting one deposit into a savings account. Is it actually helping people to progress towards greater financial resilience? Well, slight spoiler on the top of the slide there, I suppose. Yes, we do see, particularly when we've dug into our credit union evaluation, that taking a joined up approach right from the very start helps people to start building that safety net and feel more prepared for financial shocks. But what's also important here is that resilience isn't just one thing. If you imagine households coming to the point of taking out the debt in the first place, they may be at several different points along their own resilience journey. So building this savings may actually be helpful for some households to actually start managing more their cash flow over time. For some, yes, it's starting to build a safety net for the very first time. And for others, it's starting to build a long-term savings habit that helps them build a pathway towards greater resilience over time. And this isn't just about building up large balances. As one credit union member says here, even £40 can meaningfully change what happens in a crisis. And it's also not just about the money and how it's used. We see consistent well-being effects in a positive direction. People feel more control, less stressed, and less worried. And this happens even at very small savings balances. And that in itself can reinforce the savings behaviour. We've seen from wider research that optimism itself can act as a really strong predictor of future savings behaviour, and particularly for those on lower incomes. And this can also start acting as a protective factor when a financial shock hits. So where we see those that save alongside borrowing are half as likely to experience a deterioration in their mental health when a financial shock comes along. So for many households, and I think Vicky touched on this earlier, the real risk, we believe, isn't paying a little more in interest. It's about having a way to cope when that next shock hits. A small savings buffer offers control, reassurance, and an alternative to more harmful coping strategies like taking out further debt, credit cards, etc. And actually, this feels particularly important when access to future credit is also uncertain too. And in our research, we found that when we account for other factors, households that are borrowing alongside saving have better outcomes 6 years later down the line. They're 3 times less likely to be in bill arrears, and they're 6 times more likely to have any method available to them to afford that small shock when it comes along. So the key takeaway is there is no one optimal path for everyone. But for those with very low financial resilience, saving alongside borrowing can provide benefits which we believe can far exceed the costs for many. And the potential here is huge. 1.38 million people, by our estimates, in low to moderate income households are borrowers that have nothing in savings. So for these households, having access to inclusively designed, joined up borrowing and saving products could offer a pathway from having no savings at all to building at least a small financial buffer that begins to give those benefits already, and a pathway to that continued improvements in financial resilience over time. And so we're very excited to be launching our More Than a Loan report today. I really encourage you to go away and read the full thing. You've actually got the summarised version here in front of you. And please do get involved in all the discussions we're going to have today.
Thank you, Erin. It's a huge challenge to distill everything we've learned from what is really quite a lot of different strands of research into 10 minutes. So thank you very much. So turning to the panel, all of whom have experience of offering in some way a joined up model to customers and members.
I think we'd really just love to hear your initial reflections on what the benefits of joining up borrowing and saving are, both for individual borrowers, but also any reflections you have on the benefits for yourselves as kind of credit providing organisations. Caroline, can I turn to you first?
Yes, of course. Thank you so much. Thank you. I'm glad to be here. I think we've heard a lot of the points, and Erin, in the report there with the slides, I think you shared quite a lot of the information. But what we see is exactly as Vic has mentioned, as Erin's mentioned, as you're going to see in the report. The saving while you borrow is key for our demographic within the credit union. Primarily, we see people, that maybe haven't had savings in the past or think that they can't be savers. They're not in a position to save. And because of the way that we've modeled that product, it begins to put people in a position of empowerment, of being able to make their own decisions. A lot of times we see, there's a couple of things we see in the credit union. Maybe a member comes back for a second loan once they've paid the first loan. And our team will say to them, do you want to do a full loan or would you like to use some of your savings? And they'll say, what savings? They don't even realise that they become savers unintentionally. And I think that's a big piece for us. And something that we really try and instill in our membership through just talking to our members, proactively reaching out to them, but letting them know that they are savers now. They do have a little bit of money there. They can make their own decisions. They can make their choices. So I think that's a key piece to this product for us and something we see very regularly.
That's great. Thank you, Caroline. And I think there's a couple of things in that, the kind of emotional impact of feeling that you are a saver, but also I think a bit of a watch out for us that people need to know that they have the savings to sort of get those benefits. And some of what we've been looking at is sort of how do we maximise that empowerment factor of having savings. Emily, what about you and the stream perspective?
It's been really interesting doing this work with Nest Insight and Harvard this time round because it's built off the back of our auto-enrollment savings. And I apologise for being a poor research partner because when I looked at the data, over 60% of our borrowers were already saving. So it was a hugely high base, so please don't take these results as the results you'd get across the board. And that is because we've always believed in a joined up model around financial well-being, which is what is the next best thing somebody can be doing to make progress. And that can be a tiny thing, that can be accessing, a discount on everyday spending, that can be a big thing like starting to save for the first time, or it could be something sort of that sits in between. And when I look at all the feedback, which I obsessively look at all the time, to understand how people feel, so I measure a lot of feelings, the word savings just bubbles up again and again and again and again, and people talk about being proud of being saving, having that peace of mind, feeling good about themselves. And for Stream, we're delivered through employers, so we're an employee benefit. And part of what our commitment is that we will help people to be better employees and more present and focused at work. And so building that connectivity and getting them to save and feel better and feel calmer and sleep well and have better relationships at work is us delivering on that promise. So it's really core to us.
Thanks, Emily. And I think it's a really good reflection that all of you here already have a kind of joined up set of tools for people to build financial resilience. And that's not the case outside of the world that we're talking about where products and solutions are often offered in silos. So I think that's a really useful reflection that we're in a kind of quite optimal testing ground in what we're talking about here, and there are some challenges as we think about how we would scale that beyond. Asesh?
Yeah, so similar. So we, I guess our mission is very much focused on financial health, and so we see ourselves as a financial health company rather than a specific product company. The product we've scaled most over the years, and probably what we're used most for, is kind of debt consolidation. So this is employees already with debts. We help them refinance that at a lower cost. We help them pay it off sooner. And for employees, it's very valuable. They save hundreds of pounds. Debt is paid off sooner. We report the payments to the credit bureaus. The credit scores rise. It is kind of a really great great product. And what we find is there is a moment with employees where they really, really like us. And so, we have a really high Trustpilot score. We've got 24,000 reviews, 4.9. But the word lifesaver is used over 1,000 times. And in that moment, what we've worked out is if we can encourage employees, if we nudge them in the right way, they will listen to us because they like us and they trust us. And in that moment, if we can nudge them into a savings account, they will listen to us. And I think, similar to early research findings, I think the longer that goes on, when it comes to the end of the loan, some of that kind of reduces kind of over time, because you've helped them in quite an acute moment. And so for us, we're very interested in the loan to savings journey. The loan to us is really helping employees, be well prepared for emergencies, help them get out of debt, and then to make that next step. And then we think we have a real moment where we can help them do that. And I guess our key learning, which we're constantly obsessing about, is reducing friction. And so, finding the right moment, reducing friction based upon things we can do, but also as kind of employers share more data, the regulatory environment kind of helps us as well, all directions which we think have a lot of potential. And so we reach 1 in 6 employees today in the UK. We have a path to 1 in 3 employees over the next 18 months. And so if we can really crack this, we think we can make a big difference.
Thanks, Asesh. And that really makes me think, one thing I think we've learned in the work that we've done over the past few years is finding those moments, finding those touch points where people are already thinking about and engaging with money. And the moment that you're paid is one of those, but clearly the moment where you take out a loan, where you consolidate your debts, moments where you are kind of actively thinking about money are really sort of high potential touch points for supporting people, because we know that the rest of the time there's so much else going on in life, particularly in constrained households, that it's really difficult to find the time. We've talked about the potential and the opportunity. We haven't yet talked about the challenges. We set out in this work to sort of look at something differently, to think about borrowing and saving in a joined up way. Erin, you've worked across all of these different approaches. What reflections do you have about sort of some of the challenges or some of the things that we might want to start addressing as we develop this further and think about scale?
Yeah, I think that Asesh, you've just, realise I'm a louder person than others, so I'll move it further away. Asesh, you've kind of just touched on the big one, which is reducing friction, right? I know that, when we've had conversations, it's thinking about that. How do we use that moment where someone is very motivated and it's necessary to engage with your finances in an ideal world? Could that be sort of to quote you, I think, sorry, Sesh, like a one-click experience where, this is sorted, you're able to get access to that credit, but that then enables the setting up of savings accounts and this pathway, as we've just described, to financial security over time. I think that even within some of the trials that we've been working on, a lot of what we've spoken about is how to reduce the friction in really tiny ways, or the use of like defaults. So how much do we want to encourage people to put into the savings account as well? So I think there's the friction point of how do we reduce that cognitive load, but still have a product that people understand and know what they're sort of signing up for and getting into. And then I think the other challenge for me is the sustainability point. So, we've spoken about it from a credit union perspective. We do see people that go on to have this continued savings habit, but we also see a lot of people that will just fall away once the requirement is no longer there. And similarly, in some of the early trial findings, it seems like where we get this upkick in people saving, it's not necessarily sustained for a long time. So I think it's something about how do we make it easier to engage with and easier to stick with over time.
Thanks, Erin. Perhaps, Asesh, if we sort of stay with the point of reducing friction, can you say a bit more about sort of what the limitations were in the design that we're piloting? And I guess in a sort of ideal world, like what we would do differently and maybe what the barriers to that are?
Yeah, absolutely. Yeah, so we found when it comes to loans and credit, employees are highly motivated. They will go through a number of pages, they'll enter information, they will see it through. We don't see the same motivation in savings, and so it needs to be super easy. And so, we've got a new version of our kind of product launching in a couple of months' time. We've called it Easy Save. We try to consolidate it into 2 clicks, hopefully 1 click in future. But the types of things we're doing, which is we're asking employers to give us data on their employees so they don't need to repeat the same things again. So things like NI number, just details that we can reuse. Naturally, some employers are cautious about doing that, but over time, that is, the more employers that do it, the more comfortable they get. But basically, the more data we have from employers, the less pre-filling there is. Again, that's a real kind of benefit. KYC is a big factor. If we need to do KYC again, if an employee has moved house and they need to do something manual, then again, there's kind of friction there. But, if this is an employee already, they've done some checks with the employer, if we didn't have to do that, again, we could kind of make that simpler. And then just from a journey experience, and so, we were founded 11 years ago now. At that time, apps were not necessarily as prevalent with everyday workers. They very much are today. And so we're moving very much app first. And again, allowing that just to be a really easy experience for employees, we think is kind of really helpful, as opposed to emails, logins, so forth. So a combination of those things, which I think are all kind of heading in the right direction.
Thanks, Asesh. And I think sometimes we think those moments of friction are about sort of admin or inertia, but one thing I think I've really learned is that they're also about confidence, and people who aren't already savers, any of those steps require you to think, I can do this, I can be a saver, and the more of those steps there are, the more likely people are to sort of drop away and lose that kind of momentum or confidence. So I think, we are committed to working together with everyone here and people in the room on how can we just make it even easier. Emily, you've also done lots of work on reducing friction and joining things up, and I know that you've taken some of the learnings from the sort of work that we've done and kind of rolled out something more widely. Can you share a bit more about how you're thinking about these kind of challenges?
Yeah, I'll touch on two things here. So the first is how to get people to save and the friction in that journey. And Asesh is completely right. When it's something that feels like it's optional or I should do this, people aren't willing to put in the work. But they are willing to put in the work at a different moment in time. And for us, we learned that moment was signing up to the Stream app. So in that sign-up journey, we began collecting all the information we needed to take somebody through a KYC process. I would love it if we didn't have to do it. They're employees, they're employed, the source of funds is known, the money laundering risk is virtually nil, but nonetheless, we tick that box. I'm looking at you, FCA in the room. But so in that moment when people want something and they're signing up to use an app or they're signing up to get a loan, they're willing to give that data. And that allows us to do a really seamless kind of behind the scenes eKYC check for most, which means we can then open a savings account for them. And we designed our savings journey so that there was more friction not to save. It was default on, you still had to consent, you still had to see the FSCS notification, you still had to accept the terms, but it was more work to say, no, I don't want to. You had to slide down to 0. You had to tell us why. We said, are you sure? So we really made it harder not to save so that we could lean into that easy path for people, which is why we had such a high savings take-up. And then on the other side of that friction, what we've learned with the loans to savings trial is that actually we've gotten most people saving who are going to save. So people at the end of their loan will save more if they're already saving. We didn't really have a significant result getting new people to save, but we went back upstream and ran another mini trial on our own, and we ran another randomized controlled trial where we tried the save as you borrow approach and tried to get people upfront to start saving with their loan. So can we capitalize on that moment and try to convert some more non-savers? And we actually got an 8 percentage point uplift in savings at that point, which is really material. And you can see it in our data. In 2024, 58% of our borrowers were savings. In 2025, it was 62. Early part of this year, it's at 65. It's inching up as we get more people through that journey and find those touch points. But it's in that moment when they're already willing to do the work, they're already doing a hard thing. If we can kind of slip in savings as well, again, with their consent, all regulated, then it really works well.
Thanks, Emily. And I guess one thing I want to add to that is that none of this is about pushing people to do something that they don't want to do or kind of hiding something. What we've seen is that there's just, almost everybody wants to save. Almost everybody sees the need for having emergency savings. So this is really just supporting people to kind of follow through on that intention and that desire. Caroline, I'm interested in any reflections you have on Erin's kind of second challenge, which was about supporting more sustainable behaviours and conscious. At least, one reflection I have is that in work we've done on savings previously, we've been thinking about all employees. In this work, we're thinking about people who are already borrowing, and to some extent that is a more constrained population, and credit unions are so great at working with people who perhaps are excluded from other financial services and sort of other approaches. what's the sort of ideal in terms of sustainability at the end of the loan, and what do you see, and is there anything that we could do to support people better?
Yes, thank you. And I think you said exactly right. The challenge for us is on the back end, not the front end. The front end is the easy part. If somebody comes to get a loan with us, it's mandatory savings. It's already built in. The affordability is already built in there for the savings. What happens is when the loan is then repaid, life happens. Something comes up, as Vicky's mentioned. It happens to us all. Something happens. The member calls up and the savings are withdrawn. And then once we get to that point, it's really hard to get somebody to start saving again if they're not going to borrow again. And we're not going to force them to, as you've mentioned. If they don't come to us for a loan, they're not going to just walk back through the door and say, okay, I'm ready to start savings again. It doesn't happen. So one of the things that we've tried to do is be a bit more proactive with that. So as the life of the loan is coming to an end, is contact the member and explain to them, look, you don't have to continue to put that payment into the savings. We understand that life is there. You're going to need to take some of that back and kind of put it somewhere else, redirect that money to something else. But could you put a little bit into savings? Could you continue to do maybe the £10 a month you were doing? If that £10 is manageable, could 15 maybe make a difference? This is what this would look like after a certain amount of months, and show them that number, show them that figure. I think sometimes that's a big piece, is having that where a member can look at that account and go, this is how much money I'm going to have. So when I get to Christmas, that's what I've got for Christmas. That's for my food, that's for my children, whatever that looks like. So we're trying to be a bit more proactive. Another thing that we're trialling right now is for members that take out maybe a slightly larger loan, more than £4,000, so quite a hefty loan for our member base, is doubling the amount of savings that they would have originally taken out. So normally it would be £10 a month, increasing that to £20 a month, and trying to kind of get a bit more of an uplift there for our membership. So at the end of the loan, they've got quite a significant pot of money there, and to really embed that feeling of, I'm actually a saver, I do have savings, I can do this. And again, one thing that we talk about, time after time, is about paying yourself first. And I know that sounds completely counterintuitive to paying off your loan or paying a bill or paying a debt, but that peace of mind of paying yourself, putting that into a savings account, knowing you've got a little bit of money there that if an emergency comes up, we hear that time and time again from my members, that's it, that's what we're looking for. That's the piece that we find helps them more than saying, well, I've managed to pay off my loan, or maybe I paid it off a little bit early and I paid a little bit less in interest. That's not what keeps them awake at night. What keeps them awake at night is not knowing where the money for the bill is going to come from, or if an unexpected situation comes up.
Thanks, Caroline. It makes me think, I think one prior I had going into this research was that of all of the models that we could think of joining up borrowing and saving, the most straightforward, the kind of one with the most potential, was the transition to save at the end of the loan, because you've been paying off your loan, £100 a month, you come to the end of the loan, there's a bit of found money, you're used to putting it on the loan, and you can put it into savings. And that's actually, I think, not really what we've seen. I think that works really well for some people, and it is a kind of good design to think about. But as several of you have said, life is messier than that. The financial shocks keep hitting. As Vicky said, it's not kind of linear. It's not kind of pay off one loan, start another one. And so I'm really interested in these ideas of how do we design in savings alongside the bumpy journeys that people are on. Erin, you've spoken to lots of saver borrowers. Just interested in any reflections you have on kind of what it feels like to people to be having a little bit of savings alongside borrowing, and what that does.
Yeah, definitely. Sorry. I think it might have been in one of our focus groups that myself and Miriam, wherever you are, were working with. I think the description for me of realising that when someone chooses to put some money into savings, the decision that a lot of the people we've been talking to are actually making isn't necessarily about whether they would pay off an extra £5 of a loan, but often it's about actually spending £5 to take a child out for the day, or to have like a positive experience in the summer holidays. And the decision is around that, not necessarily the kind of like textbook decision that we maybe discuss. And so a lot of what we heard from people that we spoke to is, having made that decision over time, the kind of like pride and newfound sense that actually maybe I could be a saver that people hadn't associated with themselves before. And I should say that's not the case all of the time, particularly just to build on your point, Caroline. Actually, what we saw is that when people had a higher savings requirement, they got more of that fulfillment and that pride feeling, because it felt more meaningful to them to start building up the higher pot. But I think it's important for us to remember what real decisions are being made and the real impact and feeling that comes alongside.
So I think this is not a view probably held by at least most people in the room, but when we've talked about this work with some stakeholders, some people who are new to it, the sort of first response has been people should pay down their debt before saving. Like that's the rational thing to do. Just to sort of close us out, I'd love to get like maybe a sentence from each of you on why we think joining up borrowing and saving has potential, and kind of why we should be thinking about this and not kind of necessarily holding that view that paying off debt as fast as possible is always the right thing to do. I'm going to say who wants to go first because I'm throwing this at you. So, Emily?
I'll say two things really quickly. Let's get real. Those of us who have a mortgage or car finance do not sit on a zero balance savings account. We are not doing the thing we're asking other people to do. And then on the other side of that, we've been doing our own research into stream borrowers, following them through the lifetime of their loans. And by 9 months into our study, over half of our borrowers had had a pretty meaningful financial shock. So we see it in our data too. So you have to have that resilience in order to manage those shocks while you're repaying your loan.
Thanks, Emily.
Yeah, and I think, life is about being emotional and rational. And so, yes, maybe mathematically, there's a little bit of interest saving by doing one thing or the other. But certainly in the research we do, the feeling, the confidence, and we do also just think, certainly in kind of Western countries, like the culture of saving is just not kind of inbuilt generation by generation. And a lot of the time, if we can help build savings where quite often, as you said, like people don't realise if they've saved, they've forgot about it. They thought it was unachievable. Then they've got a few £100s and they realise it was achievable. Then they keep building on it. So we think there's lots of emotional kind of reasons why it makes a lot of sense, which ultimately becomes quite kind of rational, even though if the kind of interest calculations don't show it up front.
Thanks, Sasesh. Yeah, I was struck by one of the findings in the research about the power of optimism and just that feeling of optimism being something that supports people to save. Caroline?
Yeah, I think really the weight of that question, it doesn't lie on paper, it lies in peace of mind and empowerment. And I think that's the thing, it's what gets people through the night, helps them sleep.
Erin, anything to add?
I'd just say it gives people control and it gives them choice. And that ultimately is what we should be designing financial systems to do.
That's great, thank you all. So we are going to go to a break at 20 to 12, but before we do that, we've got 10 minutes or so for you to have a discussion on your tables. We're really keen that this is not a kind of talk at you. We would love to sort of start to hear your thoughts. There is a Nest Insight person on every table, so we can sort of hear people's reactions, and we will bring that back together afterwards, and it will help us shape our next steps. So on your tables, we'd love you to, I'll put these up on the slide in a minute, but we'd love you to consider, is there anything about the research findings or the discussion that we've just had that has changed your preconceptions of this topic or confirmed your understanding? What's surprising? What's just kind of confirmatory? And then what in this is most relevant to your world, to your customers or members or the people you serve? And thinking about integrating or sort of bringing together savings and borrowing, what are the limitations and what are the opportunities? You can talk about all of that, you can pick a bit off, but we're going to give you sort of 10 minutes or so, and then I'll let you know when we're ready to go for the break, and there will be more tea and coffee waiting for you. Thank you. And I should also say a huge thank you to all of our panellists and to Erin and all of our partners.